We just pushed live on Facebook and welcome everybody to the Catalyst Funding Real Estate Market Update. Wanted to introduce our special guest today and our founder and CEO of Catalyst Funding as well, Wade Comeaux, founder and CEO of Catalyst Funding.
Hello, everybody. Thanks,
and
Derek.
We have Jeff Johnson with us today, the Director of Lending with Catalyst.
Hello.
And then we also have a special guest, the single family sales manager with Lifestyles Realty Inc. We're glad to have with us today, Jennifer McCormick.
Having me.
And just want to turn it over to Wade. He's going to talk about our relationship with Lifestyles and Jennifer, and we'll get into today's market update.
Yeah, very excited to have Jennifer here today. She has been a very important relationship for us at Catalyst for quite some time. We have been a Lifestyle sponsor since, I believe, 2014. And Jennifer, how long have you been at Lifestyles?
I've been with Realty Lifestyles since 2016.
Yeah, so very long time.
Mm-hmm.
And Jennifer's always done an amazing job. She has sold an incredible amount of properties up at Lifestyles Unlimited. She has been a huge part of people building incredible wealth and affluence up there. She's always been one of the best agents at especially working with out-of-town buyers. I remember so many out-of-town buyers she works with. She really does a great job of guiding them through the process, and just super excited to have Jennifer here today. And Jennifer is recently promoted. So Jennifer, tell us a little bit about your new role and what people might want to hear about that.
Yeah, it's been exciting. It's only been a few months, but I assumed the single family sales manager role in August. Came right on in the middle of TAR changes and everything. So I'm still figuring out my norm, but it's been exciting. And honestly, I thought it was a great time because, jumping from, agent with your peers to a supervising role is never, it's got its challenges. So with all the changes, it really kind of brought everybody together. It wasn't like, oh, now I'm your boss and you do this. Like, we all kind of collaborated, all the realtors at Lifestyles, and got through those changes and how the new processes within our organization works to be compliant with the NAR changes. So that's been fun. And then I get to do things like this with my buddies over at Catalyst.
Yeah,
we were just talking about that, getting used to being on camera again. And yeah, it's just been fun and a really good and interesting time. It's been a funny market for the past year and a half, but things are changing and we're on the brink of something big. But I know we'll talk more about that coming up. So
yeah, absolutely.
So are you still doing deals yourself at this point?
I am, and I want to continue to. It's in my blood. It's really I'm doing this so long, and I do a high volume that I really don't think I can ever happily step away. It's just incorporating, maybe doing a little less deals, more things like this, taking on a higher profile role. Like I said, it got its own little challenges, but I think once it all kind of smooths out, you'll be seeing more blasts from me. In the meantime, I'm just working with my team. If I get a lead, passing it on to them and helping, just strengthen the relationships that we have. And that's really what Lifestyles is able to offer our members, your clients as well, that we get firsthand knowledge and, first right of refusal on a lot of these properties. Mm-hmm. And so we never want to pass up a lead or a deal. Like, everything's got to be worked. If it comes across your desk, so if I can't work it, like I said, I've been passing it on. So it's been a collaborative effort with our team. And like I said, everybody, I think has really unified nicely with this process of me being sales manager.
So
yeah,
go ahead.
I have one other quick question, Jennifer. I know that you you have typically had like maybe as many as 3 agents in the local Houston area that rank in the top 10, yourself included. Is that still the case for, I think it was for 2023? Are you guys on pace for that same accomplishment in 2024?
We are, but I tell you what, I think, for the last year, Houston Business Journal basically eliminated our category. So
Oh,
while we might be on track for those numbers still, the ranking, of course, means always either number one or one, two, or three, basically. They
yeah.
shift around a little bit. But myself, John, Jeff, we've all been on that top 25 list multiple times. But I think they either wanted to scale it down. I don't really have that answer, but in my mind, yes, we are all very top producing agents compared to everybody else, just because of the volume, right? We're not selling $1 million homes. Those aren't a lot of little bitty homes, right? And
Sure.
that's what it was. Our rankings were based on number of transactions per year. So
Yeah.
we're still blowing and going. We just don't have that shiny award now from Houston Business Journal.
Yeah. Well, I still think that the number of units you guys produce is arguably the biggest differentiator amongst several. But Lifestyles Unlimited, I believe, is the largest mentor of single family investors in the country. And I think arguably the biggest difference, in my opinion, is the deal flow, because we work with several. But Lifestyles Unlimited, the Jennifer McCormicks, the Moon Kims, the Danny Gentrys, the Chris Cruzes of the world do such a fantastic job of bringing consistent deal flow to single family investors. And I think that's maybe the biggest differentiator between you and some of the other groups, is how many deals your members do directly from the agents that are on staff. Would you agree with that?
Yeah, absolutely. The Lifestyles has a fantastic name as basically having a large buyer pool, a large qualified,
Yes.
motivated buyer pool. And that's our strength. And so these people, they can choose to take their deals, lots of places, but putting it in our hands, because we do have those people that are ready to move and educated and have the funds ready to go, it makes a huge difference. So it's a win-win, especially with the wholesalers. I like to say it's like that perfect marriage, right? They've got this deal, and they can choose to shop it themselves, or they can bring it to someone like Lifestyles, where we place a buyer, present it and place a buyer in contract, where they can move on and find another deal. And then, everybody's working towards, closing that one, but the cycle continues over and over, and it's just worked really well. And if you're coming in and you're like, hey, my goal is I want to buy 10 houses, then obviously that's the strength in numbers, is that we can get those deals into your hands.
For sure. Yeah, I would say if there's a wholesaler listening today, reaching out to Jennifer and the team at Lifestyles or any of the other locations is a really smart move. We used to have a We Buy Ugly Houses / Homevestors franchise. We placed a lot of homes through Lifestyles, and I think the biggest difference that I've seen is that there's a barrier to entry at Lifestyles Unlimited, like a monetary barrier to entry to be able to see these deals. So that's often a good indication that they have the money to buy it. And then 2, they require the person to be pre-approved before you can tag a deal. So if you're working with Lifestyles, they do everything possible to make sure that deal goes through. Really good at that, for sure.
I was going to ask, excuse me, I was going to ask whether you're with Lifestyles or not, Jessica. I mean, Jennifer, you deal with wholesalers a lot, right? And so are there a couple of tips maybe that the people that are listening, if they want to buy from wholesalers, things that they can do to be the wholesaler's favorite buyer and maybe get the calls for those properties either from you or directly from the wholesalers, where they want to be the buyer of choice?
And it is difficult because, well, once you start talking to any wholesaler, all of a sudden you've opened that door to a lot of wholesalers. So you get kind of bombarded individually. I would say if you're new, whether you're with Lifestyles and you're using one of our agents or not, right? If you're not with Lifestyles, I would suggest, at least the first couple of times, have some representation. These wholesalers, unfortunately don't have fiduciary responsibility to buyers. So you need someone looking out in your best interest, unless you are a real estate professional yourself and you don't know that and you're familiar with the contracts and things. But there's just certain things that you want to watch out for. But in order to be a favorite, yeah, I think it's easy to become a favorite. Just like I tell lifestyles, you know, when you're networking, when you're really putting in the effort to buy real estate and to be an investor, all of this comes down to the friendships you make, the people you know. And so that one guy who's got something and you met him, maybe you weren't first position on that house or that property, but you were at the showing and you met that wholesaler. I mean, just networking and making friends and saying, yeah, I'm ready to go and here's what I want. Because that's what people do with me. It's the same thing. They reach out to me and they say, hey, this is what I'm looking for. And, you know, I'll say, well, I don't have that, but I have this. And they're like, hey, that looks pretty good. I mean, I have a joke, you don't know what you want until you know what you don't want, right? So I encourage everybody to get out there, go to as many showings as you can. That way you're ready when they look at you and they're like, okay, does this look good? And you can say, yeah. I mean, you've run your numbers and you have that connection, especially if you're working directly with a wholesaler. You know, hopefully you can make that connection. They're good guys. They really are. They're regular people, but they have their part of the game and they're representing the seller. So, you know, if you're on your own, you need to watch out for yourself or have representation because it is two divides. It's just like a regular, you know, fundamentally any real estate transaction. There's the seller side and the buyer side. So you just want to protect yourself.
Yeah, I think that's a great point, Jennifer. We've seen some newer investors that try and work with wholesalers directly. And even though the lion's share of wholesalers are good people, it is an unregulated industry, right? It's not regulated. They don't not required to have a license to be a wholesaler. There are a very slim amount, but some bad actors out there that might not do some things that would help you make the right decision. I mean, this is a very rare scenario, but we have heard of some wholesalers even stealing people's non-refundable earnest money. But if you work with somebody like Lifestyles Unlimited, you know, you have a group there that's there to defend you. They know people for the most part, not that bad things can't potentially happen, but they normally work with people they have relationships with. And you have somebody that's reviewing that contract with your best interest at heart, reviewing the deal with your best interest at heart because they have a responsibility to represent you. I think early on, joining a company like Lifestyles is extremely important because of that mentorship and the deal flow. It's a great company because of those two things.
Mm-hmm.
All right. Well, let's dive in a little bit to the market update. I think we covered Jennifer quite a bit. Jennifer, anything else before we dive in that you want to cover?
No, guys, go on.
All right. So real quick, I do want to give a quick disclaimer. You know, Jennifer, Nor, Jeff, and I are here to give you specific investing advice. We're just giving our opinions on the market as a whole. You always want to do your own due diligence before you participate in any real estate investment. Next slide. And then real quickly, I'm going to cover a couple things that I think Catalyst is doing well that you may want to check into if you've not worked with us in the past. We are a one-stop shop that provides both hard money, which is the money to purchase and repair distressed real estate, as well as permanent financing loans. Those really fall into two categories. We offer conventional loans and DSCR, debt service coverage ratio loans, both of which are great for you if you want to build a real estate portfolio, cash flowing portfolio. We also have a pretty large real estate portfolio of our own in another division. So we try to take that understanding and help you avoid the mistakes that we've made and take advantage of some of the experience that we have. And then you will have a single point of contact. So you have one credit pull, one loan officer for all those products, hard money, DSCR, conventional. And that loan officer is going to help guide you to the best products for you as an individual, not try to pigeonhole you into products that we may offer because we don't have the full offering of all the available products. We have all those products. If you're a single family investor, we're going to put you into the best ones. Our DSCR product is really exciting right now. We actually have DSCR products that do not require the property to be leased and also do not have any seasoning period, which is a real differentiator. And we internally underwrite those and we can close them very quickly, often in 21 to 30 days, where a lot of our competition is probably closer to 60 to 75 days. And the internally underwritten differentiator is big because you have to gather up a file, send it to a third party up in Washington, D.C. or something. That's a lot more laborious process and the communication is not always great. So we think this is a big differentiator. Before we move on, Jeff, anything to add to that?
Yeah, I was going to say, we were talking, you mentioned DSCR products. So for those of you that don't know, if you want to be a buy and hold investor, but maybe your tax returns, maybe you're self-employed, you write off a lot of stuff, whatever the case may be, maybe you're a full-time investor and you can't get a conventional loan. DSCR loans are a way to be a long-term landlord. The pricing on some of the DSCR loans is equal to or better than conventional pricing sometimes. Like it's that competitive right now. So even if you do have a W-2 job, depending on the property and your specific situation, it may be better to go DSCR anyways. You might get a better price deal. They're obviously way less hassle and paperwork. There's less potential for problems down the road. I mean, it's really just measuring the property. Does it cash flow? Do you have a certain credit score? And as long as you have the assets, you're pretty much good to go. There's very few variables that's going to stop you from being qualified for the DSCR loan. And like I said, the pricing is so good right now, it may be worth it for you, even if you do conventional do DSCR. That was really it. That was the biggest thing. Like Wade said, the DSCR the product advantage that we have with doesn't need to be leased. No seasoning. So a lot of times people will buy properties, and if you get your rehab done in 30 days, that's great. You're ready to refinance. Well, if you're going to DSCR loan, most DSCR companies, they have a seasoning requirement of sometimes up to 6 months, where you're sitting in hard money for an extra 4 or 5 months. With us, we don't have any. You can refinance as soon as that sucker is ready.
And then the last thing I'll mention is a lot of people are doing cash out refinances. Rates are really improved from where they were, earlier this year and last year. So a lot of people are doing cash out refinances to fuel their real estate investments. If you only have $50,000 in the bank, but you've owned your property for 10 years, you probably have a lot of equity there. And like Dale Wamsley says at Lifestyles Unlimited, equity is not doing anything for you if you're not using it to do more investments. It's called debt equity. That's a terminology he uses a lot. So we like to help people extract that debt equity and use it to invest in real estate at a time when it's really good time to do it. And we'll talk about why it's a really good time here in a bit. But let's dive right in. So Jennifer is based in Houston. So we're going to go over some numbers here and just ask her for her gut feel about the Houston market in particular. But if you look at this compared to the other cities, the year-over-year numbers are kind of flat-ish. That's better than some of the other markets that we're going to cover in a moment for sure. You look at the average sales price year-over-year, about even, median up 1.1. But you still look at those numbers from COVID, and we're up 39%, 37% from COVID. That's just a short, 2019 to now, 5 years, and a lot of appreciation over that time frame, far higher than the historical averages. And then one thing I always like to look at is this lease price, average lease price between now and 2019. You're talking about being up about 27%. So if you got into that deal back in 2019 and you were, getting $200 a month cash flow, $300 a month cash flow, that's gone up by 500 now. Now, admittedly, you probably had some tax increases, probably had some insurance increases, but that is an exciting growth in the lease price. Jennifer, any other numbers jumping out here for you?
Yeah, I mean, since COVID, it's been a crazy ride. I promise you that. And I see it with the investment that I sell, and also I do a lot of listings whenever my clients have had their rentals for a few years and then they're ready to sell. So I get to see both sides. And
Yeah.
I always do encourage people, hey, we're going to put this on MLS because I know that everyone will pay a premium. And something else, like the average rental price in Houston and surrounding areas is $1,900 a month. And so all these numbers have continuously gone up. I mean, since, we're talking just a few years ago with COVID, we had that boom and everything, and it's just continued to go up. I mean, back when, it's harder to find a house for less than $100,000, where 5 years ago, that was the norm. So I've seen it grow. I've seen like all the changes happening. And when my clients come to me and they're like, wait a minute, $1,900 a month, that's what you're getting, in that neighborhood? And it's like, yeah, Yeah, it is. So when you see in a $2,200 for a little bit better of a neighborhood, like that is the norm. And that is just where we are. So it's shocking how in just a short time things jumped up. And I'm excited as soon as we can get past this dang election, right? And everything with next year. I'm excited to see what 2025 is going to hold, because I'm really excited. Right now, today though, you can get a really good deal. It seems like with everything going on, there's actives. You can go on MLS and see a lot of actives, and if you've got a motivated seller, now is the time to get a good price and a decent interest rate. The rates are not bad.
Right.
So I mean, it's really a good time. It's kind of the calm before the storm, I think, or the silver lining, or whatever you want to say.
Yeah. I would agree that if these home prices have not gone down significantly in this rate environment, it's been, double what it was a few years back for a while. Not nearly there anymore. Like we're down 1.5% from the peak, 1.25% from the peak. But I see nothing but upside as rates continue to come down further, because there's a lot of pent up demand. A lot of pent up demand.
Yeah, if you're buying, like to your point earlier, Jennifer, you can get good deals. I was looking at like the average out of pocket on the last handful of deals we have, and it is significantly less than when everyone thought the market was real frothy and they were paying $30,000, $40,000, $50,000 out of pocket on every single deal. Now it's significantly less than that. It's still that way. And to your point about opportunity, the prices here in Houston are relatively flat, like you said. Rents, they've gone up, what, $50 last month, $500 over the last 5 years. But if you look at those listings, like that's a big number. 48,000 relative to 39,000 relative to 28,000. There's a lot of opportunities there for you as a buyer, right? So to your point, there are good deals out there, whether it's on MLS or with wholesalers. I just know that because of A, the number of listings, and B, just the amount of money out of pocket, right? If it was a time of scarcity, those wholesalers aren't dumb. Those prices would go up, right?
Absolutely.
So it is a time of getting some good deals. There are a lot of sellers that want to get out of some of these properties. So if you're buying hold guy, now's a great time.
Yeah. Jennifer's comment about, waiting until after the election, that's a common refrain we hear. But to Jennifer's point, if you are a person who's like, I'm confident in real estate investing, no matter what happens after this, which I think is the right viewpoint on it. Like the game may change slightly, but it's still the game of real estate. And in Republican, Democrat, didn't really matter. Real estate has always done pretty darn well, right? So if you're confident enough to move forward, we're seeing people. I think the last couple of deals I looked at, Jeff, I mean, correct me if I'm wrong, we're under 10,000 out of pocket. Now that's rare. Sometimes these deals are a little bit farther out of town, or maybe we got a great appraisal, which we got some great appraisals on a couple. That's kind of unexpected, but still, that to Jeff's point and Jennifer's point was unheard of when rates were really low. You just did not get a deal for under 10K out of pocket. Like normally it was a hell of a lot more than that.
Yeah, I was going to ask you.
I keep telling people, when they were like, when we were spending too much, the rates were really, really low. And people were, wholesaler called me and say, hey, how much do you give me for this one? And I say, 120. It's like, oh, everybody else is going to give me 130. It was like almost like bidding wars. And people were scrambling to do it, to buy these homes, and okay with that out of pocket, like you're saying. But what's the difference? Well, our saying is, date the rate, marry the house, right? So buy now, especially like today, this week, next 2 weeks, get in on this, because you don't know. And if you can stay ahead of what the media is feeding to everybody else, that's where you want to be. When everybody wakes up and says, oh yeah, now it's okay. That's not the right time. The right time is to get in before then.
Yeah. Not that there's this terminology is exactly right, but Warren Buffett always says the time to buy is when there's blood on the streets. And if everybody's thinking it's rainbows and lollipops and everything's perfect, which when rates were 4.25 and we were like, oh my God, everything cash flows, like everybody was just overpaying. That's not the best time to buy.
Yeah. You can buy a lot more houses with a lot less money right now than you could have back in the day.
That's true. Exactly.
And the big thing, I'll just give everybody a quick reminder before we go to the next page. Most important number in real estate is not cash flow, it's ROI. If your out of pocket's 10,000 and you're cash flowing $200 a month, that's a lot better deal than if your out of pocket's 50,000, you're cash flowing $400 a month, right? Like that's ROI is what really matters. And then if you have 10,000 out of pocket versus 50, you own 5 homes instead of 1, which in the long run is a lot better. At the end of the rainbow, you have 5 homes worth of net
Well, you
worth.
can get a good price now. You can refinance it later,
True.
and then you're getting the cash flow and the return. Like it's magic.
Yeah, absolutely. Magic. All right, let's look at Dallas. And Dallas, it looks like we're down a little bit, right? Down median.
They're kind of pulling back a little bit.
Yeah, Dallas has pulled back a little bit, although the long-term appreciation was the highest of all these markets. It continues to be, right? It's like 57.9%, an unbelievable run up from pre-COVID on average, 49% on median.
It's
Houston and no one else is close to that. That's incredible.
20%. It's 20 points higher than Houston.
Yeah. And you're talking about 5 years, you're averaging 10+% on median and I'm sorry, 10% on average, 10+% on average, 10% on median, which is just incredible numbers. And then if you also look at the months of inventory, it's all quite a bit from where Dallas was earlier. Also, the days on market is up a little bit, but something that's still not outside of what we would call a seller's market, right? Seller's market becomes a buyer's market at that 6 month of inventory point. We're still well below that there in Dallas. So I know you work with quite a few people there in Dallas, and you were recently at the big LU Expo. Just anecdotally, Jennifer, what is the feeling on the difference between Houston and Dallas as far as the lifestyles of investors? Like, what are you guys thinking about the differences between the two?
I mean, I really can't speak about the Dallas market. I mean, we've always been not exactly the same. Dallas is a little bit higher price point, but we do have, I have a lot of clients that live in Dallas, and I know that they buy in Dallas and they buy in Houston, they buy in San Antonio. So, but yeah, I really can't speak. I mean, their numbers look like Dallas.
I was going to ask you. Yeah, I was going to ask you. So we talked to Danny a lot up in Dallas, and they've started. They've been doing it for a while now, but they're really starting to kind of expand their geographical footprint and kind of go to get the really good deals, go out a little bit further. Dallas and which is not a big deal, because if you think about, we don't really talk about it much anymore, but over the last couple of years, the population growth in the Dallas area has been through the roof. Like a ton of people moved to Dallas. So it's okay to start spreading out a little bit and buying in some smaller markets, because they're not going to be that much small for much longer. If you know what I mean? Like, not everyone's going to compact into Dallas. They're going to start spreading out. So you're able to find deals that are a little outside of the normal area. So kind of back from your perspective, Jennifer, back to Houston, are you guys seeing that in Houston as well? Houston Absolutely. Didn't have the population run up that Dallas did, but it had a pretty good one. And so are you guys starting to see kind of going into more rural is the right word, but a little further away from the center?
I think we use tertiary markets, right? Yeah. But absolutely, we've always been a long time player from the Houston area with the Lamarck, Texas City, Baytown, all these areas. That's kind of been they were the outer liars, and we were getting the great deals there. And then it's like we kind of come into an area and then we kind of explode it, and then they just look regular deals, because we've upped the prices, we've upped the values with what we do. So we're always searching for that new market, and we're doing a lot right now in Sweeney and Bay City. And there's lots of plants out there, and those are the ones that I see that, I mean, you can walk away with literally less than 10 out of pocket with a full rehab already rolled into that. And the rentals are great, like, and it is new, like, but we've been working that area for probably 3 years now. So you're not the first one in there. You're not the first guy that's going to like completely rehab a house and then get that top dollar rent, right? We've already been established there. But that's kind of what we do. And we change these markets ourselves with our own hands. Like it's really kind of special. We're providing things, these homes where I'm sure the people that live there are like, what happened here? Like everything's all new and shiny and pretty now. And they just weren't getting any attention for a long time. But what I find is, these guys that work at these plants, they like their toys. And so, a little bit of land and our garage or a workshop or something, they got their motorcycles or their weekend car or whatever. I don't know what guys do, but that's what they like. And they don't want to be in some little dumpy apartment. They want a house, and and then they make families and stuff. And then we sell the house to them later when they're ready.
Yeah, there was a neighborhood in Spring, I think. I can't remember what it was called, but there was a neighborhood in Spring where I feel like every third deal we did was in this neighborhood for a while.
Burnham Wood, yes.
There you go. This is a few years back, but every single house was, I think you guys probably did, I don't know.
We own 90% of that was our joke. But when one comes along, and it's rarer now, right? When I first started, I was in Spring or A-Leaf every day. And that's what I'm saying. Like you just kind of shift. So, but now I swear if I get one in that area, Burnham Wood or Fairfax, whatever, Postwood, there's a whole bunch right there together. But people still are fighting over it, right? Like it's still valuable. People still want it, and you should see those values. Like what's happened from when I started to now. It's like wow, like it's crazy.
Yeah. No, Jennifer slipped in a pro tip there. I love it whenever you have like a stable job environment, like a refinery or a plant or a manufacturing facility, because, especially with the refineries, a lot of the work is not permanent, but it's very lucrative, right? People do turnarounds, so that they can find it tough to buy a home, but they make a lot of money. They may be off for a month, but they may work 4 months straight and make more money than the large majority of average people out there. So that's a great environment for rentals. You got really people that make good money. They're normally pretty handy. They don't require everything to be repaired. They don't call you if the door handle doesn't work or the toilet paper holder falls down. Like really good tenants overall. So I love those areas where you have those manufacturing type jobs or plants around it for sure.
Yeah, so don't be afraid to go there if you see something you've never heard of that city before. You will.
Yeah. And we at the beginning we were a little bit more apprehensive to go in those areas, but areas where Lifestyles Unlimited is regularly going, we try to be very aggressive and have our full suite of products out there and build out a good appraiser list and everything like that. So that's gone really well for us. We know Bay City and then like Waco and some other areas that some of our competitors may not go, but Lifestyles helps us get entrenched there with. They find the contractors and the appraisers, and we kind of team up together and build out an infrastructure, and then you can be very successful for sure. All right, let's talk about San Antonio. Jeff, what are you seeing there?
So I'll just run through the numbers. So the average sales price in San Antonio is $372. That's down 3% year over year, so roughly $14K. Median, which is probably what more investors are going to swim in the median pool as opposed to the average pool, it's down 2%. Months of inventory up to 5.2, and days on market 72. So San Antonio, I don't know how much you know about San Antonio, Jennifer. I know we deal with your counterpart Chris in San Antonio. They do a good job. San Antonio is probably the weakest of the four, in my opinion, if you look at just total price. Now, big picture, if you look at that average and median 5-year run, almost 40% run up. So that's very typical and very strong. It's been a little bit of a pullback the last year. And we've mentioned it time and time again. Numerous national articles talk about San Antonio as one of the best real estate markets as far as potential goes, because the prices are really low. Relative to a lot of the country. It's a pretty stable, like Wade said, it's a pretty stable job. It's a military town. They have a lot of stable industries in San Antonio. I think it's one of those markets that once this kind of little correction happens, I do think it's going to take off. Like it's a great spot. It's really close to Austin, which is a good town. But yeah, I mean, I think, and I was talking to Wade about this the other day. I think a large part of some of it, as far as the investors, what you have to look out for is the strike force team. And if you're unfamiliar with San Antonio, if you're doing a property within the city limits, they are checking to make sure that any kind of rehab property, whether for rent or sale, had permits pulled. So if you did not do that, you need to, right? Anybody that does a deal with us in San Antonio, we require permits. It's the best $1,000 you'll ever spend. Because if you get popped and you try to do it without any permits, it's going to cost you a whole lot more than $1,000 to fix it.
Yeah, I think,
I didn't know that. Yeah.
you know, in some ways, if you're an investor, if you just go with the permits, there's some advantages to having a third party that's very experienced to make sure that the project's going well. So I think if you look at it in the right light, it's also thinned out some investors, just that environment there. So we had some people that are doing very well in San Antonio. The thing you can't do is fight the man and think you're going to win. It just doesn't work there. Like
the man is undefeated.
The man is undefeated. That's true. So you just gotta go with what the man is doing, and that's requiring permits. But it can be a very successful environment. Let's pop over to Austin, and I want to. It's very interesting. If you look at, we just talked earlier about what an equilibrium is for a market between buyer and seller. And it's 6 months. It's the first time I've seen the months of inventory in Austin be at 5.9 and the days on market be 79. That's big increase. It went from 2.5 to 5.9 on months of inventory, 49 to 79. I have seen a lot of people say in Austin, this may be the best buying opportunity in Austin ever again. Like it's a pretty unique situation for it to be down as much as it is. Median sales price year over year down 6%. There were some times earlier this year that was down 15. And then you look at months of inventory in San Antonio, 5.2, days on market 72. Such a stark difference from Dallas at 4 months of inventory, 54 days on market. Houston, 4.4 months and 51 days on market. Big differences there. So definitely that hill country area, Austin and San Antonio, is moving slower and has had more of a price reduction. But I think depending on your perspective, there's also some real opportunity there because the prices are so much lower than they were in the past. But there could be a little bit more down there in those two markets, possibly. It's really hard to tell. But I think, like we said about Houston and Dallas, if rates come down, I think there's a lot of pent-up demand, and all four of these areas are really going to shoot up if rates come down, even slightly.
Yeah.
Anything else, Jeff or Jennifer, on these slides?
No, I was just thinking to myself, we don't do a ton of deals in Austin, and I'm sure Jen, your team doesn't probably do that many because of the price points. Maybe we should start doing adding a Waco slide. We're starting to do a lot more Waco deals lately, and it's becoming a good little market for investors. So, just move on up a little bit, and Waco's where it's at.
For sure.
Yeah, I would like to get into Waco myself. Yeah.
All
right, Jeff, this next slide, do you mind covering this one for us? Active listings.
Yeah, sure. So this is a stat that Derek pulled off of Realtor.com. It says home sellers increased their listing activity in September. The growth year over year at 34%. It is the 11th straight month of growth and now sits at the highest level since April 2020, reaching a 3-year high on the heels of falling mortgage rates and the Fed's 50 bips cut. So basically what this is saying is that a lot of houses are getting listed, right? And I think part of that, there's a slide coming up here. The next one talks about percentage of people with interest rates above, like it kind of grids out where interest rates are. And I think people are finally coming to the realization that, hey, the rates are what they are. They're going to get a little better probably. But I think they're normal. You don't put a house on the market unless you're willing to buy a new one, right? So I think people are trying to finally normalize, okay, this is what it is. Rates may get a little bit better, but they're willing to either level up or just move. Like they're not afraid anymore. I think that there was a really low number when rates were higher and there was a lot of fear there and keep going up. I think people were just afraid to list the property because where are they going to go? I think now they've kind of normalized, they're going down a little bit. kind of level set, and you're going to start seeing more like normal activity. Basically, is what I think this says.
Yeah. Let's check out this next slide Jeff mentioned. I think it's pretty interesting. So one of the most interesting things is if you combine the 21.6 and the 34.6, you're looking at like 55-ish% of properties that have a rate under 4%. I think those are the people that are like, unless there's some significant reason, it's hard to get them out of their homes right now because they're going to be going somewhere else and getting a good bit higher rate. But, you know, you have another 50% that we're getting in, I think, striking range of people feeling like it's not that big of a deal. If I'm at 4.5, I'm going to 6s or something like that. I think that's in the striking range where people are starting to soften up, to Jeff's point. But you look at that big jump in about 2020 when rates really came down, because for the longest time, there was under like maybe 2-3% of people who had a rate, below that 3% number. Then it jumped way up to 20+% for a while. It's trending down. So some of those people have sold their homes, right? The people that were at a 3, and that happens sometimes. You get relocated for a job, or you have moved to be closer to family. Sometimes things do happen. But I think that particular section has been very, very sticky. So the reason why I think this is a big deal is with very small rate increases, you get within the range that people are willing to sell or buy. And that just starts to pick up the market. So every quarter, every half point drop that we see in mortgage rates can make a really big difference.
Yeah, as that red and yellow combo starts coming down again, I think that's when you're going to start to see a lot more normalization. You're going to really start to see a lot more activity, because then there are just less people locked into those. Like Wade said, you're at the 3% or less. Those people need a really good reason to give that up. But starting in, I guess, early 2022, it's kind of been slowly growing to where the bigger that pie gets, the better off real estate's going to be.
Yeah. This next slide here, I found very interesting, Jeff. You're on the rotation, so you're up on this one, but I got a couple comments on it.
Sure. So this is a percentage of homeowners' equity, and I'd never seen this thing before. I had no idea there was that much equity available to the country. So equity measured as a share of total real estate value for owner-occupied homes, it's 73% in the second quarter of 2024, the highest since 1958. That is the definition of just untapped equity, just sitting there waiting to be deployed. That is a huge number. I had no idea there was that much equity in the American real estate market in general.
It's a pretty incredible number. So what does that mean for the market? I think some people were talking about, the possibility of foreclosure boom, but when people have this much equity, you have so many options, right? The thing that happened back whenever there was a foreclosure crisis back in 08, 09 during the great financial crisis, it just wasn't that much equity. Right now, there's so much equity that people can do a second mortgage, they can sell and print money, in a lot of instances. Like, it's just, there's so many options that people have. I hear real estate investors say, I'm kind of waiting on the market to turn down. I just, if rates were this high and they didn't see that, I just don't think that is going to happen. This equity piece is a big piece of it. The other thing we talked about in the past is the underwriting quality of the loans right now is by far higher than ever. Like, the underwriting quality that was put in, and the loan products are much better. During the great financial crisis, the loan products were crazy. They had negative amortization loans, stated income loans for owner occupants, a lot of very weird things. They had loans that went to 125% LTV.
Yeah. The LTVs.
It was crazy, right? It was crazy. The products like that are gone. There's no products like that anymore. And the underwriting quality is really, really high. So I think waiting on the downturn is proven to be a bad situation. And candidly, if you bought in 3 years ago, 4 years ago, you would already have a lot of appreciation. Even though the last year's been somewhat flat, if you bought in back then, you did really, really well because you had a couple of years of huge appreciation. This next slide, inflation versus rent percentage change over 12 months. So basically this is saying You had and I don't see.
I don't think it labels the graph, but I looked at
Okay.
it. I think the green is inflation is
Okay.
what I would guess.
Yeah, that looks, I think you're right, because rents typically lag, right? But if you look at
Yes.
that trend, inflation went through the roof, rents went through the roof. And I've heard Dale Wamsley at LU talk about this in the past. That's one of the great things about being a real estate investor is if you look at this chart historically, while there's a lag time, the rents really do follow it. So if inflation goes through the roof, you're in large part insulated because the rents are probably going to go up as well. Now that you got to weather the storm for a bit. Candidly, I own a portfolio. I felt that myself for a while because like your insurance may go up because inflation's through the roof, taxes may go up, but eventually your rents are going to catch up and then often, kind of stay above it. The great thing about it is if you look at that, inflation's gone down way faster than the rents have gone down. So if you're thinking of reasons, if you think inflation is a challenge, and whenever we see the national debt and then it's going up about $1 trillion every 60 days, seems unmanageable. It's a how do you how do you protect yourself, right? And this chart really shows owning real estate long term is a fantastic way to do that. That's a big part of what we do at Catalyst, big part of what Jennifer does at LU, help you find those properties and teach you how to invest in them.
Great point. I'm curious, Jen, I know you guys talk about like buying properties and then, maybe selling some of them after a while. How many of your folks hold on to them for a long time?
Everybody is very different. I mean, Lifestyles does teach, you're going to hang on to them for 3 to 5 years as things wear down, sell them, get something else. So I hopefully too. I like to play the long game myself. I really do. But there's a lot of people, especially right now. It seems like the deals we are getting are higher in that equity capture. So that does make for a perfect scenario for a shorter term hold. I think, 2 years, but a lot of people have that plan of, let me hold it for that year and a day or whatever. And if the market will tolerate it and that's your best strategy, you can do that. But some of these literally are, have so much equity built in because the demand is less right now. We are getting better prices, but with that, we're just overall getting the better deal. And so you've got that built in. So I think right now, most people are in a shorter term plan, but I think, with mine, my original plan was I'm going to hang on to all these for 10 years. Well, now that they're approaching that, I'm like, maybe not sell all, because I've got locked in at like 3.5% and things like that, so if I've got a good renter in there, they're all different. I mean, you got to have a different strategy and play each property, each investment with its own game. You can't have the same game plan for everyone.
Yeah, that's like I said, the value of time and appreciation is tough to beat. It really is.
It's interesting. We were talking with Lynn the other day, who's kind of like Dale's right-hand person, I guess, and in large part, running a lot of Lifestyles Unlimited. She was talking about how the Lifestyles Unlimited is always encouraged at minimum either doing one of two things in 5 years, right? Either refinancing out to get that debt equity out to put in more deals or selling. And that they're really encouraging people to look at holding them and refinancing them at that 5-year point because it's not always easy to find properties. If you did a good job on the rehab, you know how the market works, you trust your workmanship, and it's hard sometimes to find new deals, right? There's costs associated with selling this one and buying that one. And they're really encouraging people to at least consider refining to fuel further growth, maybe moving into multifamily, maybe buying more single family. But it was interesting that she said that, especially in the current environment, that they're really encouraging people to keep at least some of them, if not all of them, and just refinance rather than selling.
Absolutely.
All right, this next slide is pretty interesting. So this is just showing the purchasing power in each state. And Texas it's nice, it's above It's above 100, right? It's a 103. That's a positive number. Basically, it's saying you can buy 103 bucks worth of stuff relative to the rest of the country for 100 bucks, right? So but it's an interesting track group because Texas has some real amenities. We have 4 of the larger cities with more amenities than the entire country, and still relatively affordable.
Yeah, I was looking at this. Like I know, Jen, you focus on Houston, but I know Lifestyles is starting to do deals across the country, and it seems to me you want to go to the high dollar places, right? The places where the buck will stretch further, because I'm just the opposite. I can't imagine you're going to find good rental properties in the lower ones, right? We talk to people from Hawaii, Washington a lot, and they aren't buying properties in Washington. They're buying properties in Texas or wherever. So it's a kind of a good tip. Like, hey, if you're looking for some rental properties, places like Texas, anything that's above 100 and not, I don't know, North Dakota maybe, is probably a good spot to buy a rental property.
Yep.
Yeah, we've got brokerages, just like you guys are licensed in many other states too. And I know that, I mean, it's shocking. We just did our road trip presentation last night. I think you guys are next month, if I'm not mistaken. But
Yep.
we, the differences in taxes and insurance and prices and everything is shocking. I think it was I don't know, but we had realtors on from the Kansas City, Missouri area, and then Tennessee and Georgia last night, and their taxes were like $300 a month. You got to weigh the whole deal, but it's just it differs from state to state, and their strengths and weaknesses as well. But yeah, I mean, Texas has always been a stronghold.
Yeah, no, it's interesting, and there may be some out of town members on here. And one of the things that I think is we have a lot of out of town Lifestyles Unlimited members who buy properties in Texas, and I think one of the biggest reasons that's advantageous is just the depth and the breadth of the experience here, both from the agents, but then also the vendors list. The lenders, the contractors, the insurance, like the teams that are built out here have been built for well over a decade.
Mhm.
And from mentors, like the mentors are some of the most experienced mentors. The agents have been here, Jennifer here for going on right almost at 10 years. Some other agents the same thing. So if you're looking to buy out of town, if you're in California or Oregon, there's some real advantages to buying in Texas. Even if the numbers might not look quite as good on certain things, it's just the team that is here is pretty darn incredible.
Yeah, we're very strong in all the areas in Texas.
Yep. All right, let's look at this next chart, which is just the housing starts and building permits, and they're jumping up. So, when you think about these building starts, there are people with a lot of money doing things differently than the mom and pop investors that are probably on this call, myself included. Jennifer owns her own properties and stuff. So we're not managing huge multi-million or billion-dollar budgets, but these people are making decisions based on where they see the market going. And so I think there was a lot of excitement about a little bit of rate relief and the Fed lowering rates 0.5%. That did not directly translate to as much rate reduction in mortgages as we thought it might. But nonetheless, that vibe in general is pushing a lot of starts across the country. Single family starts in particular, you see that trend coming back up. It had a dip there for a minute, but it's coming back up. And I think that we're going to continue to see that trend going forward. Anything to add to that, Jeff or Jennifer? Nope.
No. I think if we look at the next slide, I think we showed this next slide quite a bit as far as why there is such a dearth of properties. We've been saying it for a while now, but if you look at that line, that's the population growth of the country. And then you look at the number of houses were being built at that time, as you can see, 70s, 80s, everyone was we were just building a lot more properties. And then all of a sudden, after the great financial crisis, they plummeted and they haven't recovered yet. So Until that keeps going up, I think you're gonna have a scarcity.
Yep. Very true. I mean, it's a powerful chart, really is. Then I like this chart a lot. This is the rental vacancy rate, and the rental vacancies are low. That's good for real estate investors. They're trickling up a little bit, but what's very interesting is that whenever rates go up, rental vacancies go down. That's not surprising, right? Like as rates go up, the probability that people are going to be like, don't want to buy a house right now. I really want to rent because I don't want to go with a higher rate. That's you can see that it's happening right now. When's the last time it happened? When rates were the highest they've been in the last 100 years, 1970 to, the mid 80s was whenever rates really went up. I mean, there were times in the 80s when the rates were as high as 18%, right? Interest rates. And the vacancies were low then. But as rates started to come down, you could see it became a little bit of a different environment. So I think that's a good trend. If rates continue to stay high, appreciation may not go up as much, but your properties are probably going to get rented real quick. So that's another way in which you're kind of hedging yourself as a real estate investor.
Yeah, I was talking to a guy who said basically vacancies are the cancer for real estate investors. And Jen, I don't know. Are you involved in helping your people lease these properties or no?
I don't want to lease my own properties. No, I have some. But yeah, I've never had a problem. Fortunately, all of mine are occupied right now, and I have great tenants, knock on wood. So, but yeah, when people come to me and they ask, I definitely say, look, if you guys want to try and rent it yourself, go for it. Do the thing just so you can say you did, but then call a professional.
Yeah. All right. Next slide, real quick. We're almost wrapped up. We're going to try and respect everybody's time. You see the interest rate chart? Jennifer said it earlier. Rates aren't that bad. I mean, you look at it, they're basically in line or lower than any period until maybe 2003 or something like 3.
Yeah.
Historically, still really good. We just had unbelievably ridiculous low rates for a while. As a reality.
Spoiled. We got spoiled.
Yep. So you can make money in any environment, and it's just you do it a little bit differently. You're not going to do one house and make $500 cash flow in the current rate environment, but your ROI can be as good or better, and then you can refi at a later date. So last thing we want to cover real quick, and then we'll just go to a couple. I think we have one question and then one very kind comment for Jennifer, but from somebody who said she helped him buy his first house, which is nice. But just real quick on the affordability index, we always show this. Really what this chart could be called is the lack of affordability index. And this is one of the reasons that we're big believers in real estate investment here, and we feel very good about our lending business, is because of how affordable these areas are. If you think about Los Angeles, Miami, New York, some of the biggest cities in the country, best amenities, then you got Dallas, Houston, Austin, big cities, great amenities, arts, great restaurants, things to do, entertainment, sports franchises, all these great things that kind of people want to be around, but exponentially less expensive, right? If you look at these numbers, 86% of your income in Los Angeles has to go to your mortgage payment, where, that's a crazy number, right? Whereas you get down to these other areas, you got 47% Dallas, 44% in Austin, 43% in Houston. And the thing that sticks out every month, it's amazing. San Antonio down at 30%.
I was about to say San Antonio.
That's a great number.
71. That is way down. If you're looking at San Antonio, like Austin's been pretty consistent. Like it's with the recent dip, it's a little more affordable now. And Dallas has been very consistent, and Houston to a lesser degree. But San Antonio, man, that thing is way down there. I think that's why people talk about why it may be a good buying opportunity in San Antonio.
I think it definitely is. You look at it, and it's been the same trend for a while. Income in Houston, 63K-ish. San Antonio is only about 1,000 less, but the average home over there is 272, and in Houston it is 364.
90,000 less.
Yeah, that's a crazy number. So anyway, good trends overall for the state of Texas. You know, it was a little bit more affordable for a while there back in October of 2023. The trend is changing a little bit, but overall still a great vision for the future. And then I was just going to take this one question. Somebody asked, Greg asked, can you discuss thoughts on price trajectories with all the VC funding chasing single family market? So VC, venture capital, there's a venture capital investing company. So maybe this question, I'll reframe it to what I think may be intended, but there are a lot of major companies that are investing in single family real estate. There's no doubt about that. It's always been difficult to scale. And that's why the mom and pops, still the large majority of homes, last time I saw is like 86% of homes are owned by investors who own 10 or fewer properties. The reason is it's just tough to scale. You know the local market. You can get out there and look at the property quickly. You have the ability to manage it better than they do because they're in New York City or Los Angeles, and it's just tough to manage from afar. There's a lot of advantages. I mean, if it were easy to scale, every home would be owned by big companies, but it's just difficult to scale. And that's why mom and pop investors throughout history have used single family real estate to change the financial futures of themselves and their families. So is it pushing the prices up a little bit? Yeah, I saw some prices that they made were crazy. Then you also had several of those companies go out of business because they were overpaying, right? Zillow, I think it was, created an entire division to buy single family properties, went out of business. I mean, there's a lot of them that have happened. So I don't think the market's overinflated right now because rates are really high and we still haven't seen a price reduction. So I don't perceive it to be inflated, in my opinion. I think it's only going to go up from here. If I thought it was going to go way down, we wouldn't be lending 75% on hard money loans because that would be a risky proposition. And I think that, the market's going to go up from here. The next question is statement. Ivan Lopez, little props there, Jennifer. Love Jennifer. She helped me buy my first home. So if anybody's needing to, if any Lifestyles members need a deal, call Jennifer. If you're not Lifestyles, maybe reach out to Jennifer and talk about what it would be like if you were there, because it is a great organization. Teaches you how to do it, gives you homes to do it, which is great. Jeff, do you am I covering this last one by Robert Grayson? What is the going DSCR rate and points? You know that a little bit better than I do.
Yeah, sure. So obviously it varies based upon your credit score and the property DSCR. But I would say if you're looking for a general term, somewhere in the mid to high sixes with say 1.5 points is a good starting point, up to say in the mid sevens to 0 points. So it's between the 6.5 and 7.5, and the points vary from 0, 1.5 to 2. But like I said,
it's good.
Conventional, same ballpark. Like they're in the exact same ballpark. So
yeah,
now it's a good time. I'll have somebody reach out to you, Robert.
Yeah, we definitely will. Jennifer, it's a real pleasure. Very excited for you on your promotion. You're doing great things over there, and very excited to see where you are. We'll bring you back in like maybe 6 months or so, and you can tell us how you have taken the team to an even higher level. I'm very confident it's going to happen.
Hope so. All right, guys. I love you.
All right. See you later, Jeff.
Thanks, Jeff.
Thank you.
Thanks, everybody.
Everybody have a great day. Thank you. Thanks, Derek.